Yo. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, your social media insurance broker. And today, what I'm going to do is I'm going to do a brief training, about almost an hour-long training video that goes into a topic that a lot of insurance agents right now are, if you will, popularizing or kind of influxing on, which is two products, the IUL and infinite banking. One that is IUL can be used for infinite banking as well, but traditionally the whole life insurance policy is used for infinite banking. So what I'm going to do is I'm going to show you guys a training video from an actual wholesaler of an actual carrier that we use, because the real way that you as an insurance agent are going to get the knowledge of these products is by learning it from the wholesaler. Especially if you're with an IMO, they're generally often product push based. So they're just going to tell you to push the product, but they're not going to explain to you things that you're going to hear here in this video, such as different types of risks, BCIs, etc., etc. So give me 1 second. Let me present the screen to you, and we're going to get going. This is from my MGA, Managing General Agency, CG Wealth Solutions Group. And you're going to see my principal, Charles Gallier, and you're going to get to hear me talk as well. So without further ado, here we go.
Awesome. Thank you. Okay. Well, hi, everybody. As Charles mentioned, I've got some exciting news to start off our day with. Can everyone hear me okay? Yep.
Yes, hear you
Good.
just
Thank you,
fine.
Charles. Thank you. Yep. I just want to make sure my audio is coming through good. And the other thing is, can everyone see my producer workbench screen? Okay. Perfect. Okay. Well, with that, before I start on the illustration portion that we're going to do today, Charles mentioned we have some hot off the press exciting news. We have updated our accelerated underwriting limits. We are now going up to 2.5 million, and that will be for ages 18 to 50. That is in all 50 states, including New York. So good information to share with you today. Again, accelerated underwriting is going to be at 2.5 million, and that is effective right now. So we can go all the way up to 2.5 mil without lab work. So I think that's awesome. What we're going to do is we're going to start off by doing a max funded IUL contract. So how we're going to get into our software, everyone I believe knows this. We're going to click on create an illustration. That's from the producer workbench homepage. We're going to arrow down. We're going to launch Life Designs now. Your name as the agent will already be filled in here. You're just going to click the login button. That will get you into the login screen. From here, we're going to click on clients and cases. Since I have so many hypothetical people built, I'm not going to build another client for today's training session, but if you did need to build a client, you would click on this top gray box out to the right. You would click on new. That would take you to a screen where you could data collect your client's information. Don't forget, use a date of birth whenever possible. We are an age nearest company, so we always want to make sure we're accurately quoting people at the correct age. Once you have that client built, we're going to click on the bottom gray box. We're going to click on new, and we're going to hit basic illustration. Let me see here. Okay, Charles, I thought that was a new chat that came up. My apologies. So yeah, anytime you guys have questions, put them in the chat, and I'd love to do it at the end where we can just open it up for questions if that works for everyone as well. So what we're going to do is we're going to go ahead and use the growth IUL. That's going to be the IUL that I would recommend for your max funded situations. Remember, we do have two IULs. The Value Plus Index UL, that has that age 90 no lapse guarantee. So that's an awesome suggestion to pass along to clients if they're looking for something with maybe a little stronger guarantee without going all the way to a whole life contract. But for today's training, we're going to do a max funded IUL. We will pick the growth because, as the name implies, that is focused on cash accumulation. The next drop down would be our rate class. We'll go ahead and make this gentleman a preferred non-tobacco. The next thing we're going to do is the face. Now, if we knew a particular death benefit, we could leave it at input, but typically with these max funded illustrations, what the conversation typically goes is you are finding out how much premium, let's say on a monthly basis, is your client wanting to fund something where they can put this into an account that will grow tax deferred for tax favored supplemental retirement income at some point down the road. Again, I've got a 40-year-old right here. This would play very well. Maybe this gentleman is a small business owner. He doesn't have a company 401k. It's something where he's maybe put off saving for retirement, and now he, talks to you and he's like, I really want to put something together on a tax favored basis. What we would do here then is for the death benefit, I would recommend starting with a minimum non-MEC death benefit. What this is going to do is allow the death benefit to be as low as possible, maximizing the cash accumulation. To get it as low as possible, we do option B while the gentleman is funding the contract. So we're going to say, for sake of pretty common pretty common normalcy here. We'll fund to age 65, and then at age 65, we'll switch it to death benefit option A. So you're going to have B from 40 to 65 and option A from 65 on. We'll hit the return button. Next thing is we need to leave this premium on input, because how much on a monthly basis is this gentleman going to contribute? Let's go ahead and just say, for sake of illustrations, let's do an even $500. He's going to fund to age 65, and he's going to do that on a monthly basis. So this is really important that we put the proper dollar amount in that they're wanting to fund. Out to the right of that, to age, you put the age 65, because that's how long this particular illustration is going to fund. And then we'll have the monthly mode underneath that. If you're going to utilize the lifetime income rider, I would click on the Writers tab and make sure the age that you have the income starting matches how long they want to fund until, or at least some point after that. For some reason, our software likes a default for just 10 years out, and that's typically a little too soon to really turn on that income. So let's say I want the lifetime income at age 65. I've done nothing else to this illustration, so let's just review. I have the client information. I've chosen the growth IUL. I've made him preferred non-tobacco because I've done my field underwriting, and I believe that preferred non-tobacco is a fair rate class for him. I've made the face amount minimum non-MEC. That will drop it to the absolute lowest death benefit amount, maintaining its non-MEC status. I've done death benefit option B until age 65, and then I've switched it to option A. I've also told the computer that I want to do a premium of $500 all the way funding to 65. Let's hit the preview button. The preview button will launch the illustration. And let's give it just a second to populate. Let's give it a couple of seconds. Okay. I don't know why it makes it so small when I preview that. I have never figured out my default there. So the first thing I'm going to do is show you the ledger. So let's get down to kind of the meat of the illustration. So what we've done, as this 40-year-old has asked us, is we're putting away a $500 monthly premium. The minimum non-MEC death benefit is just a shade over $100,000. What's also nice is while he is funding that, we have it at option B. Now, the definition of option B is the specified death benefit plus the account value. So what's very neat about that is this is an increasing death benefit while he's still working and while he is still funding this contract. This is a 40-year-old. He probably has, let's say a spouse, or a life partner, children at home possibly. So this is a great death benefit, because if something were to happen to him and he does have an early death, this is something where not only the $100,000 is left to his beneficiary, but it would be the $100,000 plus the account value. That's the definition of option B. So gives him that increasing death benefit. He's putting his money away. All of a sudden now we're age 65.
So here, ladies and gentlemen, what's being explained to you is something that often a lot of agents who are against cash value life insurance, explain. Oh, well, you only get the cash value or the death benefit, not both, which you would never get the death benefit because you would have to die in order for the death benefit to be passed on. But this way, as the account value grows, the death benefit actually grows. So, in certain scenarios, when the policy is structured properly, your beneficiaries do, in fact, get the death benefit and the cash value. Let's continue here.
We are going to switch the contract at his request to an option A contract to levelize that death benefit out and stop funding at that time. Now, if you were just looking at the cash value, he does have just a little over 260 some $1,000 at the end of that. If you were going to look at our lifetime income rider, which is earlier in the illustration, let me show you that. It would yield him with that $266,000 of accumulated account value. If he turned on the lifetime income rider, he would get a little over $1,400 for the rest of his life. Now, that is not a bad little supplemental retirement plan. He put his $500 in until he was age 65 and then turned on the income. And then guess what? It goes on indefinitely until his death. So it's just one of those kind of set it and forget it. It would be an amount of money that he could count on then to supplement his retirement income. Keep in mind it's non-taxable because this is treated as a policy loan. So he's not having to pay taxes on that $1,400, which I think is a huge benefit when so much of our supplemental retirement income is taxable. This is a way to put some funds over in that tax deferred or tax-free category. This will then, at death, his $1,400 would obviously cease, and whatever remaining death benefit was intact, that would be payable to his beneficiary. Now, what's great about this lifetime income rider is, yes, we're paying it out as a loan, but we will never borrow out the extent of lapsing the policy. And that's one thing you have to be careful of with traditional loans and withdrawals, is you don't want that policy to lapse. This structure would never lapse. We have a threshold death benefit amount that it would never go lower than. And I believe the states are pretty constant on this, should be around like a $15,000 minimum death benefit, which at that point in time would be almost like for final expenses. But again, he's received his $1,400 and there's a small death benefit left for the family at his time of death. Now, a couple of questions that does typically pop up is I want to make sure everyone is mindful of their compensation on this. Now, remember, I asked for a minimum death benefit. So with this, it went all the way down to $100,000. You are paid, your compensation, first year compensation, is based off of target premium. Where do you find target premium on an illustration? Down in the lower right-hand corner of each page, the numbers that precede the forward slash. So this particular target is $1,281.47. So let's just call it, just for sake of simplicity, let's just call it $1,300. So this is a $1,300 target premium, even though
So for you, the consumer, that's actually important to know as well. Most IUL illustrations, you can actually look at the bottom right and see what your insurance agent is being compensated off of, right? So you can see, for example, the rapper Waka Flocka had an IUL where he lost some odd million of dollars, likely because the agent set it up as what's called target premium instead of like this wholesaler from the carrier is telling you how we're compensated in when we do a minimum death benefit maximum cash value, then you end up the agent end up taking a loss. The insured, meaning you, the client, gets the benefit of a max funded policy. The insurance company gets the benefit of you putting a bunch of dollars and them having less dollars at risk. And we actually take a loss because the insurance company punishes us for doing the best thing for you, as opposed to what a lot of agents push is, oh yeah, just buy the Target bite. You know, I can get you so much death benefit for X amount of dollars. Well, the major purpose of life insurance, yes, is a death benefit, but the wealthy insure one life at least 7 times. Therefore, situations like this, a max funded IUL should not be your only policy, and it should not be the policy that you're looking for to leave a legacy to your family. It should be the policy that you're looking for to benefit from whilst you are alive. But remember, we, the agent, take a serious haircut on our pay for actually setting you up the proper way. So everybody else, the salesperson benefits. You, the insured, benefit, and the insurance company benefit. Let's continue.
So the client is paying $6,000. Most of your compensation on this then would be treated as excess premium. If it made sense, this is the minimum death benefit. There is nothing that precludes you now from raising that death benefit for illustration purposes. I asked the computer to maximize the cash value. If you wanted to, and if it made sense for the client, you could definitely still adjust the death benefit if you wanted to raise the death benefit, which then in turn would also raise your target premium. Now, I'm not saying that I want you to always raise a death benefit for comp purposes, but I'm going to tell you a little secret. You know, we're all doing this to make a living. And I want you just to be mindful at the end of the day of how your compensation would work. I don't know, Charles and I talk about this is that, target premium is kind of what drives everything. So this is the minimum death benefit. The only way to raise the target is to raise the amount. So if, for instance, I wanted to input the death benefit instead, I'm going to leave that $1,500, but instead of a $100,000 death benefit, which is where it started, maybe I up it to 150. I just manually up that. I didn't do anything else besides up the death benefit to 150. Now the target premium before was at 1281. Now what I just want you to, just for sake of explanation, again, this is a training session, so I want everyone to be very mindful of how these numbers work. Couple of things, let's look at target premium. It's now up to 1900. So now we're at 1900. And if we look at the lifetime income rider, it really didn't affect it in a large amount. It's at 1382. Alonzo asked a great question. How can we assure this client isn't underinsured? Well, remember that that's part of the conversation that you need to have with your client. And you know this, Alonzo, you know it quite well. I'm showing you how to do a minimum death benefit, maximizing the most dollars I can basically squeeze out of this illustration. That doesn't mean that the minimum death benefit is ultimately where you're going to land for this client. He might want a higher death benefit. By all means, that's why you meet with them, do your fact finding, and find out what is most important to them. I was pitching how to show you the minimum death benefit. We can always raise it from there. So now this lifetime income rider went from 1418. You guys can correct me if I know it was only a minute ago, but my brain is kind of all over the map today. I believe it was 1418. We raised the death benefit a little bit, and it took the lifetime income rider down to 1382. So not a huge decrease, but now we've got a much higher death benefit that we're starting with. So instead of starting with $100,000, we're starting with 150. Remember, we're still doing death benefit option B. So this is increasing as he is funding this all the way to 65. This death benefit grows quite nicely from 150 to 200 to 250 to 270 to 325. It is going to tap out at 406 before we switch it back to option A. This might be the ticket for this gentleman. This might be kind of like a nice.
So one more thing I want you guys to notice, and this is for financial professionals who may be watching, and obviously the general public, which is who I want to speak to the most, obviously because I want you all to meet my client, right? But is that he also or she also, uh, as you can see, I'm very vocal in those sessions. I typed it in the chat at the time. You'll hear me come off and talk, but I challenge them often. This is why I'm good at what I do. But if you'll notice, this illustration was initially for a 40-year-old, and very much like I say, nobody should be paying for life insurance for their whole life. which is why that buy term invest difference sounds so good. Because with whole life, most agents are only trained to make purchase a whole or pay for a whole life in perpetuity until the day you die. That's not exactly the best way to do it. Now, when you do limit the amount of years you pay into a permanent policy, it does increase the price a little bit. But think about it as paying off your mortgage early, right? If you pay more dollars upfront to your mortgage, that's going to decrease. That's going to shrink the amount that goes uh, uh, in perpetuity paying your mortgage, right? Like if you just make one extra payment a year into your mortgage, that'll drastically cut down that 30-year mortgage. So it's the exact same thing when it comes to life insurance. Yes, you're paying more upfront, but over the length of the lifetime of your life, you end up saving money because it's also building cash value. So in this scenario that Christy so eloquently illustrated, she illustrated a 25-year term of paying for a whole life policy. In this case, an index universal life, but that's still a permanent or whole life policy. So my big thing is that you should never pay for life insurance for your whole life. It should be a term of time that you pay, not a term policy, but a term payment. Let's continue.
Blend of death benefit protection and cash value. I just wanted to point out that the minimum death benefit is nice to know because then you know where your floor is as far as this $500 a month. Because remember, you kind of have to know where you're starting to know where you're going to end, right? So I just like to show everyone how to do an illustration. The minimum non-MEC gets you your minimum amount, but by all means, like I just did, I just upped it a little bit because maybe with my conversation with this gentleman, he does have a death benefit need as well. And because it didn't affect the cash value in a huge amount, it was still a nice blend of death benefit and cash. Let's see here, Alonzo, would the switch from option A to B just an option C? No. So option C, that's a great question. Option C is an increasing death benefit, but it increases by the premiums paid, not by the account value. So when we look at this increasing death benefit, remember, as our cash is accumulating, our death benefit is making nice big jumps. If we did death benefit option C, that $150,000 that I asked it to start at would only increase each year by $6,000. So it would go from 150 to 156 and so on and so forth. So yes, death benefit option C, some people, Alonzo, it's funny we haven't talked about it yet because I've got some advisors that prefer option C over option B. Again, I don't think there's a right and a wrong. It's only what suits the needs of the client. But death benefit option C is still increasing, but remember it increases each year by the premium outlay, not by the account value. But that's a great question. Okay, that is how we overfund an IUL. Keep putting your questions in chat. I'm going to go ahead and go back to this 40-year-old gentleman. The other thing that Charles and I had spoke about was utilizing on whole life, utilizing paid up additions to overfund a contract. So why don't we take a quick peek at that? So I'm going to start a new illustration. And now instead of UL and IUL, I'm going to pivot to whole life. The growth whole life contract is what is designed for supplemental retirement income, max long-term accumulation. This is the product.
So paid up additions are what I are the way that you can actually create a infinite banking structure through traditional life. And like I said, it's generally done with a whole life, not a universal life. But when Nelson Nash came up with infinite banking indexed universal life insurance, it did not yet exist. Now, the major difference between indexed universal life and traditional whole life, or just traditional whole life, universal life, period, is flexibility of death benefit and premium. So what you're going to see here is something called the flexible paid up additions rider with this particular carrier. It may be called something else, but general term across blanket term across the industry. So now what happens is with traditional whole life, and the reason I don't find it as my favorite product with infinite banking is because it has to be structured. So you have to know, hey, listen, initially I have a $500 a month premium that I'm willing to put up, but I could pay an additional 200 to $500. Let's say an additional $500. So instead of your premium being $500 a month, it would be $1,000 a month. And anything that goes outside of the cost of insurance and things like surrender fees or surrender charges go towards your cash value. The difficulty with a traditional whole life is that you are beholden to that premium payment for the time that it's scheduled. So let's say it's January 1st and you and I sit down and we say, okay, $500 for premium, you're going to commit to $500 additional. Now you have to commit to $500 additional for a scheduled period of time. So let's say you want to say that additional 500 you can commit to for one entire year, right? So that means that you're committing instead of $6,000, you're now committing $12,000 for that one entire year. The difficulty is after that 1 year, you cannot fund any additional money. Your premium drops from the 1,000 to the 500, and you're stuck. You can't now put more money into it. And if you be at a point where maybe you didn't get overtime, or you didn't get your Christmas bonus, or you didn't get your commission, now you're still beholden to that $1,000 premium. Whereas with an index universal life, there's the flexibility of premium. You can say, hey, I got my Christmas bonus, I didn't. I got my commission, I didn't. I hit the lotto, I didn't. I want to add an extra 1,000. I don't want to add it this month. I'm gonna add it next month, and then the month after, I'm not gonna add it, and then the month after, I am. That's the flexibility of premium. The other difference is the flexibility of death benefit. As you noticed, she was talking about option A, option B, and option C with the So these multitude of options are why I personally prefer IUL, and why a lot of other agents are now being trained to prefer IUL. And as they learn more about how the product works, generally that's going to be a lot of agents' favorite product. Now, people like myself and Rael, we've been talking about some high level stuff. I'm going to be releasing some of that information, but a lot of people aren't even going to be able to be in the position to actually utilize a lot of the strategies that we're talking about, because a lot of people can't get over the hump of thinking that life insurance is just a check for someone when they die versus a bigger check for yourself while you're alive. So continuing, let's get back to it.
That I would use if I was going, excuse me, to overfund a whole life contract. So let's kind of do apples to apples here. We'll run him preferred again. That's what I did before. Remember the very first one we did was 100,000, but we ended up with 150. So let's go ahead and just take a peek. Let's see what the premium is for 150,000 for this gentleman, because I don't know what it is, because I'm going to run it right now. So 218. Okay. 218. Let's think about this. So we want to overfund that 218. Remember, we were going to do $500 on the
So notice there, actually, hold on, let me do it like this. So if you notice here, she has the initial premium, and the face amount now is $150,000 death benefit. So now we're looking at the overpayment, but because you committed to that 500 in the IUL, and we can set it up so that we minimize the death benefit and maximize the cash value, you can't exactly do it the same way with a traditional. So what she's doing here is doing the flexible paid up addition. So we're going to do a face amount of 150,000, which in this scenario has this gentleman paying a premium of 218. So whatever is above 218, 240 or 50 something to add to. So now your premium payment is going to be the 218, and then everything else is what you'll schedule for the overpayment to make it flexible paid up addition. So the flexible paid up additions are now a way that you can have additional debt, additional cash value with a uh, fixed debt. Now, this is where you'll hear people say, well, when you overfund it, you don't get the death benefit and the cash value. And that's not exactly true, even with a traditional whole life, though this traditional whole life is a level face amount. But as she continues, you'll learn a little bit more about that as well. So let's
IUL. So let's see what max overfunding will get us to. So we're going to go into the riders. What we're going to do is select the FPUA rider, that is the flexible paid up rider. What that will do is allow, like I said, overfunding of the contract. Now, what I'm going to do to keep it a non-MEC, I'm going to use this little maximum 7-pay button. It will automatically calculate how much paid up additions I can additionally put into this contract without it becoming a MEC. So same idea, kind of that we did with the IUL. We want to make sure we're keeping it a non-MEC. Now, why is that? I always love to tell people, MEC is not a 4-letter word. A MEC is not always bad. But for supplemental retirement income, we want it to be tax favored. And because of that tax favored, we want to keep it a non-MEC. Why? Because then the distributions would be tax free. All right, so I'm going to do a maximum 7-pay, keeping it a non-MEC from age 40 to 65. We'll hit the return button. We'll do nothing else but hit the preview button. And let's see what it maxed us out at. And remember, I'm just asking for the max. That doesn't mean we can't adjust it, but I like to see what I'm dealing with here. So let's see what that maximum overfunding, still keeping it a non-MEC, would actually come up with. So give it a few seconds and we'll see what the premium is. Okay. So I'm going to go straight to right here. So what, I made this a little bit bigger. So the max overfunding gets us a total of $449. What that did is, remember, our base premium was what? I already forgot what it was. 218, 220, whatever it was. The overfunding, thank you. The overfunding is an additional $230. So you can see right here, the max funding amount is $230. So if we add those premium dollars together, we get not quite where we were on the IUL, but we're close. We're at $5,395 as an annualized payment. $449, basically $450. Let's call it $450 a month. So this is if you wanted to show an overfunded whole life contract. Same idea, right? We've got a nice increasing death benefit, and that's what is great about these paid up additions, because check out what this death benefit does. Yes, it starts at 150 right here at day one, but by the end of the first year, because of our paid up additions, we're already at 159. Then we grow to 168, 193, 234. Let's take a peek at where we are. At age 65, we've got a cash value of about $190,000. Now, remember, this is going to be a continuous pay contract unless we do something about
it. And if you'll notice here, thank you, Ra. I'm glad you're appreciative that this is that dope content. Unfortunately, social media doesn't tend to or a lot of people who consume social media tend to like to consume mindless content, or flashy content that seems to be too cool for school. The reality is, this is what the wealthy people do, right? Wealthy people are wealthy because whatever it is that they focus on, they hyper focus on it. To most people who aren't interested in it, it's boring, except for the flashy outcomes when you're driving the G-Wagons, right? But this is what gets you into the G-Wagon. This is one aspect of what gets you into the G-Wagon. This is my aspect. somebody who does real estate, their aspect is not going to be just the sale of the house, but how to structure a deal, how to get the best bang for your buck, whether that be the buyer or the seller. But if you'll notice here, even in this scenario with the level death benefit, it still increases over time because when you throw so much cash into an insurance policy, laws regulate that it can't do a certain thing or it can't have a certain amount of cash without increasing the death benefit. So the NAR or net asset at risk has to be he says, let them stay on the hamster wheel. That's their choice. The net asset risk has to be or a certain amount above what the person is putting cash into. Again, this is actually she actually put up there uh, maximum 7 pay. So 7 pay is actually the law that came out, and I'll do a video about that in the future, called TAMRA. TAMRA is a law that came out in 1988 because those billionaires and the rich that we like to tax use life insurance as a tax shelter. Because life insurance is a tax shelter. What is it? Well, they used to buy a really small life policy, like $50,000 death benefit, and stuff $200,000 of cash, and then it would grow tax free and tax deferred, and then they just borrow it because you can't pay taxes on a loan, and they would basically legally cheat the IRS. So the federal government puts laws into the place to stop millionaires and billionaires from doing it. This is why millionaires and billionaires came up with people like Dave Ramsey and Sue Zorman. And this is why companies like Ameritrade, which is now Charles Schwab, used to pay Sue Zorman to say, don't buy whole life insurance. Those agents get up to 90% commission. Guess what? The guys who sell term life insurance also get paid up to 90% commission. And there are people who are online, specifically on TikTok, who are saying things like whole life insurance is a scam, invest your money. You realize that you're investing your money in the same company that sells whole life insurance. So if their whole life insurance was a scam, that means their term life insurance was a scam, which would also mean in turn that their investments that they offer you would be a scam. So what is a scam? It's someone telling you that an insurance is a scam. Now, the major issue is you do have some people like Bandman Kevo and Jay Morrison and Prince Donnell who are getting into the insurance field now, and they're making it seem scammy because they're actually breaking down, ironically enough, some truthful stuff. The problem is they've been scammers for so long. Let's get back to the video, however.
About that. Now, there's a couple of things we could do with whole life. The first thing I'm going to show you, which I think is one of the simplest to quick illustrate, is I'm just going to do a reduced paid up contract. So if I tell the software that I want to be done paying premium at age 65, I put it into RPU status, and let me show you what it does. I did reduce paid up at age 65. And that's because I'm trying to do somewhat apples to apples. It is hard to exactly compare IUL and whole life because there are different, product designs at work. But I do feel it's something that, some of you love whole life, some of you love IUL. What I love is that we sell both. So we're able to give your clients basically, the product that fits their needs. That's what I like about this. I'm going to leave this as a large screen. Now, because I put the contract into paid up status, it did allow a little bit more money. Remember, I was maxing out the non-MEC overpayment. Well, because I now told the computer that we're limiting, it's bumped it up just a little bit. So now we are over that $500 mark on the premium, but now we're done at age 65. I paid the last premium payment. We're at a $460,000 death benefit with $231 of cash. Now, because we put it into RPU, we lose a little bit of death benefit between age 65 and 66. Why is that? Because I put the contract into paid up status. It knows that there will be no more premium dollars going into this. So that $231,000 of value will purchase a paid up amount of the 415. But remember, it will start growing again because we have the dividends basically purchasing paid up additions. So there's a lot of moving parts here, but I think the illustration speaks volumes. It really gives you an opportunity to show your clients, just again, some different options. All right, I'm going to take a breath and I'm going to take a quick drink. And what else do we have for questions? Okay, with IUL, does the increasing death benefit mean that the net amount at risk increases as well? This is what's funny. It should be level, because when you have your definition of option B, it's the death benefit plus the account value. So what happens is with option B, your net amount at risk, which is the difference between your death benefit and your account value, it should be that level. It should be that level death benefit, and we can go back and look at that. So that remains level, the net amount at risk, until you flip it back to option A, and then your net amount at risk will actually start decreasing as that value shrinks over time between your death benefit and your account value, if that makes sense.
Hey, Christy, can you talk a little bit about the safety of these products? I know one of the concerns with the IUL is what if the market crash? And can you
Sure,
talk a little bit about the indexes and the guarantees? And also, I know
sure,
you have
sure.
the current interest rate for December, which is more than, I know we talked about it before. The actual current rate is actually a lot more than what can be illustrated.
Correct.
So I don't know if
Yep.
you
So
want to
let's
talk
go
a little
back
bit
to the,
about
no,
that.
but I will. I will.
Okay.
I'm going to launch that IUL illustration again. I'll have that up in front of me and point out a few things. And again, it keeps going small. Let's blow that back up so y'all can see what's on my screen here. So the first thing, there's a couple of things that Charles mentioned. And the first, well, it was actually the second thing, but I'm going to start with it, is the actual cap rates. So when here, let me make this, I'm trying to get a little bit more on the screen, but not too small so you can't see it. I don't know how, is that too small? I'm not sure. I want everyone to be
So
able to
also
see.
here, you'll end up seeing a lot of pages, and especially an IUL illustration. The reason being it is a very complex product, and this is why often a lot of agents do, in my opinion, need some experience with security to really be able to explain this stuff. You know, you see like the S&P 500, the 20-year history guide on these products, right? So here you see the Morgan Stanley International, the Russell 2000, the S&P 500, monthly index, the S&P 500, 2-year point, and the S&P 500 1-year monthly index and the 1-year point to point. So you're going to see different par rates. You're going to see a bunch of stuff here. I actually do ask questions of Christy during this training session. But the reason that these things are important, uh, very largely because most agents aren't going to be aware of this stuff. Just like you would ask for an investment advisor to give you a prospectus, which is the forecast of the investment vehicle that they're asking you to enter into, but it also does show some history. Now, you should also be aware that prior performance does not dictate the future results, but it can kind of be a barometer, and you can kind of see. The beauty here is these 0 years or these negative years. Well, the 0 years obviously don't really have an effect on anybody, right? It's just flat. But for example, you're going to see a lot of negative years. Those negative years don't harm you if you're in an IUL, because it just leaves you, it's basically a 0 year versus anything else. So, for example, where you see this -6%, -19%, -38%, I tell people, listen, any year if you're in an actual participating investment, if you have a -20, if you have a 20% loss, the following year, just to get back to even, you need a minimum of a 25% gain. And that's just on the interest, let alone the money management fees, the taxes you may pay, which you're not going to pay taxes on losses, but the taxes you may pay, and obviously, like I said, the money management fees. So you're probably going to need a 30% gain the year after, a 20% loss to get back to your starting point, let alone to get above your starting point. But that's not what this is about. So let's continue. I just wanted to give a little clarity to that portion.
All the different index options, which are listed at the headers. And then what happens is we are showing you the 20-year history, assuming it had our current cap rates applied to it. So for instance, as it stands today, the S&P 500 index 1-year point-to-point cap in the state of New York is 7.5%. So if you back test this on what the S&P 500 has done over the last 20 years, the 5-year average would have been a 6% return, applying that 7.5% cap. The 10-year is 5.25. The 15-year average is 5.5, and the 20-year average is 5.2. So when you look at the illustrated rate, and I'm going to make this bigger so you can see this heading, see that 4.98? We are not far off from that 20-year average, because the thing that you want to feel very comfortable with us is that we are not overpromising. We are very aware of the illustration gains that can be made out in the IUL marketplace, and we want to do our best to make sure we are putting our foot forward in the client's best interest. And what does that mean? We don't want the smoke and mirrors. We don't want to pull the rug out from under their feet. We want to show them something that at the end of the day, they know is something very, very possible and very feasible. So with us illustrating a 4.98%, remember on an IUL illustration, that illustrated rate is assumed day one for the life of the contract. IUL illustrations are not designed to go with the ebbs and flows of the actual stock market. I kind of wish they were, but hey, that's not my place. I can't change that. But this shows a level return of 4.98. Are you going to get a level 4.98% return if you were in the S&P 500 index? What do you guys think? Yes or no? Are you going to get a level 4.98% all years starting year one? Somebody hear me? I'm watching the chat. Yes or no? Thank you, Charles. A big no. That's not going to happen. We're not going to see a level 4.98% return. But when we look at this illustration, we are looking at 3 different things. We're looking at the 4.98, which is the columns all the way to the right. We're looking at the center columns, which is the 4%. That is an alternate scale, more off your fixed rate of return. And then you have your guaranteed column all the way to the left. Now, the guarantees are the worst of the worst. Not only is that assuming a 0% floor, which remember on an IUL, 0 is your hero, because if we have a negative return for the market in any given year, the client will not have they will not realize a market loss as far as a negative return. They will get 0. So 0 and above is what a client will earn each and every year. So assuming a 0% return all years, and assuming we're charging the maximum cost of insurance charges we can, that's where your guaranteed column comes into place. So let's see how long we have coverage based off of the premium they're paying. So age 82. So as illustrated, this illustration is guaranteed to have coverage to age 82. Does that mean you will have coverage only to 82? Well, there's a lot of things that would have to happen. Like I just said, you'd have to have a 0 each and every year. Is that possible? Yes, but probably not probable. And then the other bigger thing to keep in mind is the company would have to start maxing the charges that we actually assess to clients. And that would be, I mean, yes, that could happen, but we're not in the business of doing that. And we're a very financially sound company. So I don't foresee that happening. But when Charles asked me to talk about guarantees, That's the worst of the worst, is your guaranteed column. Something that's more likely is probably the center column, which is the alternate scale. And then again, if you want to compare it to anything, I highly recommend utilizing this 20-year history table because it's historical for a reason. It tells you what the different indices returned, and then it also gives you a column that shows you if our current cap rate would have been applied. So, okay, let me see what Mr. Hall has to ask now. Can those interest rates change depending on? Yes. So basically, if you look at the headers on these columns, the current cap rate is 7.5%. Or are you talking about the illustrated rate, Alonzo? Are you asking me if the illustrated rate can change, or is the cap rate subject to change? Because each indice has its own cap rate. So maybe I'll answer both questions that I'm making up. Yeah, the cap rate. Thank you. So the S&P 500 1-year point to point right now today is at 7.5%. If we did the international indice all the way over to the right, that's an 8% cap. So yes, depending on which indice you choose, that will dictate what cap rate you're issued with. Now, here's the funny thing. The illustration doesn't change. We're assuming 4.98% no matter what your choices are. That is what we are illustrating, unless you ask for a fixed rate. Then that would be a little lower. Otherwise, any index option will give you an illustrated rate right now of 4.98%. And some people kind of balk at that. They'll be like, Christy, that's kind of low. You know, why? You know, I can see higher returns with other carriers. And I'm not arguing that, because you're absolutely right. I promise you, there are other carriers showing higher non-guaranteed illustrated rates. We just, as a company, are very conservative with what we project because, again, we would rather under-promise and over-deliver. And illustrations are just that. They're illustrations. But they're what we're using to facilitate a sale. So we want to be very mindful of being really putting our customers first and foremost. So I kind of get on a soapbox about this, but I do think it's a good thing. And yes, the red flags article, if I'm so glad, Alonzo, you pointed that out. For any and all of you that want to have an awesome read on IULs and rate setting and illustration gimmicks and just different things. I shouldn't even say gimmicks, just illustration options that some carriers are taking. We put out an article. It's written by Kelly Halverson, who heads up our actuary and our product development, and it's phenomenal. It is a really good article. So thanks for pointing that out, Alonzo. Charles, what else do you want to talk about with IULs?
Can you get into the a little bit about the different indexes, like the S&P, the 1-year point to point, the 2-year, the uncapped ones, just to go over that, if you don't mind.
Just to see, well, back on this screen, and maybe I'm not catching your drift here. I apologize if I'm not. These are all the different index options across these columns. Remember, so if we chose the 1-year point to point, that's this first column, that's the 7.5% cap. Then we have another option that has a higher participation rate, but a lower cap. Then we also have a 2-year S&P 500 index point to point. Now, why is that cap so big at 16.95? Because it takes you 2 years to get that return. So 2 years, 16.95, not a bad cap. Then we have a monthly option on the S&P 500. So because that's monthly, it's a much smaller cap because.
So, Rod, to answer your question, I did not yet see that, but I definitely will be taking a look into that. And yeah, we do need to get on the ball. We have opportunities are coming in. But, you know, with the spaces that you and I frequent, and the circles that we're in, definitely, especially with folks like you keep me abreast because I can't be on top of everything all the time. But we work as a team, right? You make me aware of something, I make you aware of something, somebody else in the group makes us aware of something, and part of my job is to be on it, and then part of the brotherhood is the fact that you know, you keep me on stuff, so now I can look at it. And it's a selfish thing, right? I'm looking at it for you to make me better. You're looking at it to make me better so I can better serve you. So thank you for letting me know about that. Now that's something that I can do my research in, get to the people I need to get to, and start asking the questions like I'm asking this person here, right? So I ask them because I'm obviously able to get into the rooms with them. I can ask the questions to them. So that's why when I do these lives, the trainings live. I actually did this training live on TikTok. But I ask you guys, hey, shoot me questions that I can ask them because I can't always think of the questions that you can because I don't have your situation. You might be in a scenario, hey, I got, wife and kids or two kids, no wife, or wife, no kids, or no wife, no kids, or I take care of my grandpa or whatever it might be. Those are things that your life scenarios are going to be different. So that's why there's no one size fit all product for anyone. But I'm definitely interested in that 100 billion, bro. We got to get us some of that.
Again, we're capping that out on a monthly basis. We do have now the S&P 500 is predominantly large cap stock companies. The Russell is more small cap, I believe. So it's just a little bit different sector, just a different makeup of companies that make up the Russell 2000. And so that cap rate is actually a little bit higher. It's a 9.95% cap rate. And then we have an international indice that's at an 8% cap. So what's great is you can slice and dice these however your client is comfortable with. You do not have to allocate 100% to one index option. You could do 50-50. You could do 25, 25, 25, 25. I mean, you can really do the allocation however you want. It obviously just has to equal 100%. Is that kind of what you were getting at, Charles?
Yes, thank you. Absolutely.
Okay, cool. Yeah, yeah. Well, I still have some time. We've looked at those were the two illustrations I wanted to show everyone how to do. What else? I mean, this is for you guys. Okay,
I guess if
let's see.
somebody wants to ask a question, you can raise your hand. I can take you off. I can take you off.
Well, and Alonzo just put one more question in
In fact,
chat, so I do want to.
I'm gonna let Alonzo.
Um,
Alonzo, you can
okay,
talk. You can talk
he
now.
can speak. You
Yes,
you have to let Alonzo speak.
I did. I just did.
I'd be
Thank you.
disappointed.
I know that was killing him. Putting in the chat.
Yes, you know that was killing me, Charles. You know I like to run my mouth. So yeah,
Oh, we love you, Alonzo. We love you.
and thank you, Christy. So yeah, I definitely wanted to ask because I do want to be able to explain those a little bit to clients. I have clicked on, like the little hyperlinks to kind of to look at, I guess, the prospectuses of those. But I know there's the sector rotate, and these are products outside of New York. New York doesn't allow there's a limited amount of
Correct.
interest we have
Correct.
there. But I know we have I know on the annuity we have the sector rotator, but I believe now on the growth IUL 2, we have the
Mhm.
sector rotator RC2 5% and
Yep.
the Mark 5.
Yep.
Um,
Yep.
the Mark 5 is really interesting,
So,
but there was a lot on it.
yeah.
And I didn't quite grasp it. Can you kind of speak to that a little bit?
Well, I am definitely not an indice expert, but what I can tell you about those is those have volatility controls put on those indices. So remember those fives,
How to
see the
be
5 in
strategy.
the sector rotator and the 5 in the Mark 5. That's a very important number to focus in on because that 5 is a goal. And you want to remember, you talk about volatility of these returns. And if what a volatility controlled indice does is it tries to take out the peaks, take out the valleys, and try to give you something in the middle. And they are truly focusing in on that 5% return. So I kind of giggle because at the end of the day, really, when you look at these 20-year averages on these other index choices, were they right around 5%, Alonzo? I mean, we were looking at the S&P. We were looking, I mean, 5% is like a golden standard for an average for an index option. So I kind of laugh that I feel like, I don't want to say they're all going to end up the same because that is not at all what I'm saying. But I do feel at the end of the day, the goal is around the same thing. So it's just another choice. Because sometimes you're going to beat that volatility control, and sometimes it's going to be worse. So I just caution people: you do have a nice participation rate on those choices. Just keep in mind anything that's volatility controlled, they really are trying to like take out those big spikes in returns.
Makes sense.
Yeah. Awesome question, though. Thank you.
Hey, Christy, can you talk? Because we have new agents that's joining us, and if you have it's always the question, like, what should I have a client, which way should I go? Should I go the IUL route? Should I go the whole life route?
Oh,
with
that's a
the
loaded question.
rider?
I
Like, how can you get them? How
I
can
know.
you
Well,
diagnose that?
Yeah, here's the deal. At the end of the day, if the client really doesn't have a strong opinion, I let the illustrations kind of speak for themselves. If they understand the differences between the guarantees in whole life and the modified guarantees that we have in IUL, but then they understand there's maybe some more upside potential in the IULs versus the whole life contracts. Again, it's really what is going to resonate the best with the client. I don't think there's a right and a wrong. That's why we offer both. So I think it's a great question, Charles, but I think for the experienced people.
So in these scenarios, often, like she says, you want to offer both. And the idea is for, as an experienced agent myself, I definitely want to present the client with both options. It also really depends on your goals and your income levels, and then your risk tolerance. Even though there's virtually no risk in either, there are more guarantees in a traditional whole life. You're not going to see that what we say is the guaranteed column in a traditional whole life. In IUL, there is some volatility because they are reflecting an index. Now, as she mentioned earlier, it's really the guaranteed column in an IUL is likely not going to happen because that would mean that the index would have to return zero year over year, over year over year. Now, the importance of that is because a lot of investment only advisors will say, hey, just throw your money into something that will get you 10%. But they don't speak to you about something called the time horizon. The average time horizon of an investor is 20 years. So something that gets you 10% is the 10% over the amalgamation or the correlation or at the end of that 20 years, meaning basically for 20 years in a row, you got 0.5% a year, right? And then at the end of 20 years, 0.5% over 20 years adds up to 10%. Whereas these returns, we're talking historically, the S&P has returned 5% year over year over year over year. But again, you have to look at things like risk tolerance and time horizon, even with these products, because if you're looking to put, $100 in and get $1 million out next week, it's probably not going to happen. However, if you're looking at that happening where you put some money in and then can take some money out this year, you're gonna have to put a pretty penny in, right? It's not just something that you can throw, even depending on your age, $500 because of the cost of insurance. And that's why it's very important to get a policy younger. That's why, as opposed to UTMA or UGMA, which are just custodial accounts, and you're not an investment advisor or an investment professional, so you don't know about the management. Yeah, I'm gonna get a great check off of it and be like, yeah, you set your kid up, but that may not be the actual situation or the final goal that you're looking for. So part of working with a financial professional is to be very concise and clear with what it is that you want, so that we can actually turn that around and give that to you. It's just like if you go to a private chef, right? If you go to a private chef and say, make me a steak, and then they make you a steak slathered in mushrooms and hollandaise sauce, and it's medium rare, but you wanted a well done steak with fried onions. Well, you had to say to that professional private chef, hey, I want a steak in onions, and so on and so forth. Let's see what you're saying here, Rob. I don't even like the risk tolerance aspect, because life insurance should be a group effort, a family being a starting point for that. So there should be a collective approach to life insurance. There should be a collective approach. However, we have to, especially in our community, bro, we got to realize that most Americans, I was on with an author with the Forget About It or Hold the Fog On podcast, and he was explaining, hey, we really don't understand this stuff. I don't understand it, and I'm a white guy, so to a lot of what I call the bliggedies that think, white people are just all super rich and stuff, it's not the case, right? Yes, they happen to, as a community, focus on the wealthy as opposed to the dregs of society, like we do in our community. We focus on the Migos and 50 Cent and LeBron James, and great, he can slam a basketball, but he probably doesn't have the best fiscal plan for himself. That's why he surrounded himself with people. I had a relative who was like, Jay-Z doesn't use a financial advisor, he got it out the mud. Jay-Z wouldn't be where he is if he didn't use a financial advisor. Jay-Z happens to get money off of the fact that who he is, and a lot of those who are uneducated want to look to him and think, well, he made money through rap, so he must be able to correlate that to other things. Not exactly. Let's see what we have here. Life insurance really demonstrates how separated most Americans are regarding estate planning and wealth creation. Yeah, to be honest, a lot of Americans think home ownership is the fastest way to generational wealth. It's not. Property ownership is a fast track to generational wealth, but that means owning a property that you don't live in. Now, the fastest way to generational wealth is life insurance, because within a matter of a generation, whether I die or not, but I'm going to die, right? We're all going to die. I don't know anybody who's made it out of life alive. So with one generation, you can actually infuse millions of dollars of capital to the next generation, but you also need to instill that generational knowledge. And that's one of the things, especially in our community, that is lacking. We leave them a house, and then that house gets lost. I'm in a situation like that with a house in my family. It's been in my family. My great grandmother was one of the first Black women in New Haven, Connecticut to purchase a house. That house is currently still in our family, but the family is on the verge of probably losing it. The boomers in my family are the ones whose names are on that deed, and they're dying off. The major issue with that is, blessings to my grandmother. She just had a birthday yesterday, right? She's in her mid 80s, right? She's got maybe another 20 years, God willing, right? But then who it goes to next? Who's going to actually pay those property taxes? Because right now we have a relative in there paying property taxes, but as far as I know, the property is infested with rodents, and there's not enough income coming in. Nobody's putting our dollars together to actually improve that property. I want to buy the house and live in it myself. Will they let me? Probably not, because when I try to talk to them, oh, well, your uncle, he works with lawyers. Great. I actually had my real estate license. Hannibal says, how can adults with jobs can't get together and take care of one health financially? People are selfish. Hannibal, if that ain't the truth, I don't know what is, but that is the truth. All right, let me get back to the video for you guys.
people in the field,
Mhm.
I'd love to also get feedback from them, because you guys are the ones out there, hitting the pavement doing this. Do you show both, or do you go with what you like a little bit better? I mean, I don't know. I mean,
So
I know that at the end of the day, something is better than nothing,
I
right?
can
So I
add
don't
some
care if
context
they
there
do
if you
whole
like.
life or IUL.
Yeah. So I'll add some context there if you like.
Yes.
Generally, what I do if I'm laying it out to a client, first of all, especially in New York, we kind of have to act as a fiduciary anyhow, um, due to stuff like Regulation 187. So you do want to present it both, but I kind of explain to the client, look, with the whole life and things like the FPUA rider, you are beholden. You have the guarantees, but you're beholden to that payment. So I'll tell my client, hey, if you want to pay an extra $1,000 a month, that's cool, but you got to let me know up front. And we have to schedule it. So if you let me know January 1st, 2025, that you want to pay an extra $1,000 a month for the next 10 years, just know that you're paying $1,700 a month because your premium is $700 plus that thousand, and for 10
Mhm.
years. And then at 2035, it cuts off. You can't put another penny in. With the IUL, you have the flexibility of premium. So if you want to pay an extra $1,000 a month this month and then not next month, there's no spigot to turn on or off except for calling up and saying, hey, I want to add an extra $1,000 this month. And then next month, it goes back down to your regular premium unless you decide to add additional funds. So I definitely do put the ball in the court of the client. And you want to, this is why it's important to do fact finding. Because if you just become an order taker, and now I'm kind of speaking to the newer agents, if you just become an order taker and you're like, hey, you want, because people are going to call you because they're watching TikTok and Facebook and YouTube, and they're like, hey, I heard about the IUL. So you want to make sure that you take them through that discovery session and explain, explain, explain. The first time you explain it, their eyes are going to roll in the back of their head and they're not going to understand. That's why we don't do one call close, right? I know it seems attractive to do one call close, but that's why you want to have at least 2 meetings, because you don't ever want to get that E&O case. So present it to the client.
And what Alonzo said is important. Like when you do the IUL, you have to really every year you have to really you have to do it when it's issued. You have to do a annual review, in my opinion, every year, every 2 years for sure. And you kind of don't want the clients calling the customer service line directly, because you have to remember the customer service people, they are not licensed, and they're not, they're just here's the premium, and they can give the client, they can say, hey, well, your target premium is only 1,300, right? And but we built a program for them to pay $6,000 a year, and something like that, that'll just blow up your whole illustration. So you got to be careful. Definitely want to monitor these accounts, and work with the people. Christy said you lost a audio.
Oh,
All
no.
right.
I think it's
Yeah.
back.
Oh,
Can you hear
there
me?
you go.
Yeah,
Yes,
we
there
hear
you
you,
go.
Christy.
Yeah. I apologize. You. Okay, well, hi everybody. As Charles mentioned, I've got some exciting news to start off
Sorry,
our
guys. I don't know
our
what happened
day
there. I had
with.
some technical difficulties. Let me speed this back up. Gonna roll in the back of their head and they're not gonna understand. That's why we don't see if I can catch us back up to where we were. Right?
Computer and connection dependent. So I'm so sorry. Yeah, I lost audio. Can you hear me?
Yeah, we hear you perfectly.
Yeah.
Okay. I'm like, I was trying to get my headset reconnected, so sorry about that. No, I feel like I'm on borrowed time now. It's
That's fine.
cutting in and out.
And if anybody else has a question or something they would like to see, you can put it in the chat, or you can raise your hand. I can take you off mute.
Yeah, guys, don't be afraid to ask questions. I do like to talk, so
I know,
don't
I know,
mind.
I know. Christy went through this. I don't know how many 1,000 times Christy went through this with me before I finally got
I know, but
it.
hey, you've got it. You've
Yeah, I
got
got
it.
it now. Yeah, got it now.
And I want to say thank you, Christy, because the option C was something, and you can definitely ask Charles. Charles definitely toots me as the IUL guy on the team. And option C was something that I had never touched,
Yep.
because I just didn't quite understand it. So now that I understand
Not a
it,
lot of people use it. Yeah, not a lot of people use it, Alonzo, but it is an option.
I'm still not a fan of option C. Option B for the win for me all the way,
Yeah,
but
it's the one I like. It's the one I like too. But like I said, it is. But again, I was not familiar with option C until I came to Emeritus. My prior carrier, we only did A and B. I didn't even know there was a C. So
Mhm.
my point is, it is something that is out there in case somebody asks you about it.
Yeah, and that's why we have these sessions, because you can
Yep.
always learn more.
And how can you tweak the that was the one thing I wanted to ask you, because you were showing the, with the target premium on the with with the with option B, you were showing the target premium.
Mhm.
Is there a way
Mhm.
to increase the target premium and overfund it using option A as
A.
well?
Yeah. I knew that's where you're going because if you do option A,
Hmm.
that's going to raise your death benefit, which would help your target as well. So yes, you could do that exact same thing that I just went through, but just keep it at option A, and that would raise your initial death benefit, which would raise your target, but then it would keep your death benefit a little more level from the get-go. Again, everybody's got their own kind of recipe that they like to use, but option A solve on the minimum non-mech would be a higher death benefit. You could totally do that as well. I just like to show everyone the bare bones, like where you start at the bottom, because then you can always work your way up from there. But
Question.
yes, option A. Yes.
So, because I just thought about this, because I actually have a client who may fit the description. So I'm looking for a little clarity with premium. Before I ask her my question, I do want to go through a little bit of something, which is when you're looking at these overfundings of life insurance, you have to keep in mind that we are salespeople. So I generally set a barometer for my clients. Um, Generally, if you're spending under $20,000 a year on your policy, there does still need to be some meat for me to make a living. So I will generally set those policies up with an option A, which does increase your target premium. But I would, not mind being paid for the work I do, just like you as an American want to be paid for the. Let me put this up. For you want as an American want to be paid for the work that you do. But once you start going 20, 30, 40, $50,000 a year into the policy, you're also changing things like your tax bracket, depending on how you pay into the policy. This is why we also talk about, again, tax shelters. And the way we tax shelter them, I'm going to be talking about things like 401ks, solo 401ks, self directed IRAs, qualified and non qualified plans, 412Es, which is a great tax shelter. It's a retirement account funded fully with life insurance and annuities, not with investments. So you do have those guarantees there. Generally, not an IUL, and generally a traditional whole life, and then with a fixed indexed annuity. These things are what the wealthy will take advantage of, and they'll usually do an executive carve out where, unless you're a certain person, not a key holder, but like a C-level executive, will get these things. So even your upper and middle management and upper management, they don't get exposed to this type of stuff, or things like split dollar plans. If you go to Google and Google Jim Harbaugh life insurance with Michigan University, when he was a coach there, they actually loaned him $2 million a year for his life insurance policy. That life insurance policy is not meant for him to die and leave money to his family. It's meant for him to, when it's time for him to retire and quit coaching or separate ways from Michigan University, which he recently did, which is why he's now the coach of the LA Chargers, he can actually start taking that money. right? And they'll recoup some as well, because they'll recoup from what he's recouping in the form of a loan, that $2 million. But now he's got a lifetime income. And depending on how he accesses that money, he doesn't have to pay any taxes on it. So imagine somebody putting $2 million away for you for 7 years. You're earning interest on it, and then you're able to access it paying $0 in taxes. Right? But let's get back to this, because I actually asked her a question about a specific type of client. He says life insurance is the yellow brick road. It really is. And that's why they call it life insurance, not death insurance, or when I die, leave somebody a check insurance. But marketing has done so. Let me get back to the video for you guys. Oh, shoot. Hold on. I just took the screen away. Hold on. Here we go. All right. Stop my camera. Stop. Premium finance is because I know PPLI, you need at least a $10 million net worth to really qualify. But I have a client who's interested in premium finance. His annual income is around 1.5 million, so he's definitely there. He has a couple of $1 million.
Kind of recipe that they like to use, but option A, solve on the minimum non-MEC, would be a higher death benefit. You could totally do that as well. I just like to show everyone the bare bones, like where you start at the bottom, because then you can always work your way up from there.
Question.
But yes, option A. Yes.
So, because I just thought about this, because I actually have a client who may fit the description. So I'm looking for a little clarity with premium finance. It's because I know PPLI, you need at least a $10 million net worth to really qualify. But I have a client who's interested in premium finance. His annual income is around 1.5 million, so he's definitely there. He has a couple of $1 million in assets, maybe not 10 million. But my understanding is premium, like you only need around $1 million worth of net worth, and then maybe $1 million worth of collateral for a premium finance case. Is that the situation?
I think that's a general rule of thumb, depending on the lender. Any of you that want to talk about premium financing, we have our advanced planning department.
Okay.
They specialize in it. So I know enough to be dangerous. I would always much rather you go directly to the experts. But yeah, that's I think that's a general rule of thumb, Alonzo.
Okay, yeah, because
Yeah, they actually have a firm that they use that deals with it. I forget the name of the firm, but there's a special department, Alonzo, in Emeritus that focuses on premium finance.
All right, because I got two that I can think of right now. One is Marty over there in Brazil, Charles. But he's got a couple of people he's introduced me to. And they, ironically enough, they just invested in some hotels in Colombia. So I want to, while they're getting that going, talk to them about some life policies.
So we can actually get Troy, because that's way outside of this context. We can get Troy Branch or one of those guys from Advanced Markets to come on. I know I went to when they had a session in Cincinnati. It was a whole separate firm on top of the Advanced Markets that use that, because those are like real special cases. So it's not, you know, if you have a client there, you are one of the fortunate ones. That's not the regular CNAs and RNs and that we're working with. But with that said, Kirsty, we'll disconnect. I actually have a delivery. So there's a question in the chat from Joe.
Oh, that's a good question.
Can't see it.
Where and how do we choose? Oh, it's on. There is a supplement when you fill out the IUL application. When you're on eApply, there is a supplemental page that you will choose your index option. So that is part of the application process. Great question.
That's an illustration. It's an illustration as well.
Oh, of course. Yep, there's an allocation on the illustration as well. But again, it's not going to change your illustration, because remember, the illustrated rate is the illustrated rate. Right. But yes, you can choose that on the illustration as well. everyone, before I lose audio again, I want to thank everyone for their time today. This is one of my absolute favorite groups to work with. Charles
Thank
knows
you.
that. I don't
Mm.
just say that lightly. I think you all are very special. You have a great group. For those of you that I haven't met in person or I don't know that well, you're in great hands. Welcome to Emeritus. Welcome to CG Wealth. I feel like I'm losing audio again. So and Miss Roslyn, I do
Hey,
know you.
Roz.
So thank you. I am going to sign off, Charles.
Yes, we're
And
finished. We're actually
I
finished. Yes.
appreciate. All right. Thank you, sir. You guys
All
have a
right.
great day.
All
All
right.
right.
Thanks.
Take care.
Thanks.
Yeah, won't
Thanks,
have
everyone.
we won't be at Fogo de Chao. We'll go to a vegetarian restaurant.
All right. All
See
right,
ya.
everyone. Hey, have a good one. I'll talk to you, and I'll be here if you need me. All right. Have a good one.
Thank you.
All right. Bye bye.
So, guys, that was a training that I did. Like I said, I personally have 10 agents who are on my team, who are under my tutelage. And one of the things that I'm very strict on is definitely the understanding and knowledge of these policies, which is why I can understand why companies like Primerica exist, because they really want you to get the grasp of a certain product before you go out there slinging product and hurting people, right? Whole life is not that complex, but this IUL thing is really complex. And it's disturbing because you've got a lot of agents and IMOs, which is independent marketing organizations, who are now coming together and they're recruit. You got guys who got, 4 or 5 years of experience, and you would think, well, 4 or 5 years of experience, you would be good. But what happens is there's this thing called continuing education, which you have to continue to go through to actually get that knowledge in these different types of policies. And so what happens is, people don't quite know what's what with these policies or the ins and outs of how they work, right? It's like fundamental basketball. Yes, LeBron James knows how to dunk a ball. He can cross people over. Kyrie Irving has the best handles out there. But initially, they had to get the basics. How do you dribble a ball? How do you dribble the ball from your right hand to your left hand? How do you move with the ball? What's a chest pass versus a bounce pass versus a lob versus, a between the legs pass versus behind the back pass versus a no look swishy pass. But you got to really just get the chest pass down and then the bounce pass down before you can get that behind the legs, triple double, triple axle, spinning around, looking the no look pass like, Kobe Bryant used to do, right? So these are things that you have to get the fundamentals on before you can actually start to go into what we were talking about, which is advanced markets, right? When you heard me ask Christy about things like premium finance, she's a wholesaler, but she's a fundamentalist, right? Now, when you're talking about things like premium finance and that deep dive stuff, you heard Charles say, yeah, we got to get to the advanced market. That's the guy named Troy Branch, right? But even in the advanced market, we actually have outside CPA firms and attorneys and accountants who all they do is this stuff. Your general accountant, your general CPA is not going to know this stuff. He's not trained on it. Your general CFP is not going to know this stuff. He's not trained on it. They're generalists. Just like when you go to the hospital, if you go to the doctor, your general doctor has a little bit of knowledge about what goes on with your heart, but that heart doctor is the guy who specializes in just doing heart stuff. Now, he can go back to the general stuff because he has that knowledge, but his knowledge goes above what the general doctor knows. So, ladies and gentlemen, I am not going to hold this up too long because I have some stuff to do on my end with clients. So, I'm going to go ahead and end this out. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description. With that being said, ladies and gentlemen, wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. wipe ass. Work in progress every day and see success. And remember, folks, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.